Right. I mean, let's get straight to it. I mean, the media has a tendency to over-obsess over issues as, like Brexit, and obviously it's a very complex issue, so sometimes, a lot of people miss the point. I want to ask you now, what in your view is that one risk that we should all be talking about that hasn't seemed to garner a lot of attention as it, I guess, pertains to maybe financial stability?
We're pretty much in hands-on mode now after 10 months of preparation. We are now having this 2-year transition period. Listening to the positions, I'm not extending that this period will be prolonged for the Brexit, that we are talking about a 2-year period. And it doesn't look like a soft Brexit to me at all. It looks like either a hard Brexit or a very hard Brexit. So now is the time for the banks and the market participants to prepare for that. I believe that the Brexit is manageable for banks. I truly believe so. But I think we need a very thorough preparation, and we have to do this in a very efficient manner. There is a financial stability risk for European corporations, and the biggest financial stability risk I can see is that the products, let's say German corporates have been using and have been buying in London, will not be available on the continent. So it's very important from a financial stability point of view that investment banking products which have been offered to London will be offered somehow on the continent in a legal way for European corporates to buy them. Otherwise, again, I think that Brexit is manageable for banks if and when there is precise, efficient, and thorough timing and preparation.
That's a big if, though, Mr. Dombret. I guess in the event that banks might need to pull out of London, and I know the Bundesbank isn't exactly promoting Frankfurt to be the plan B, if you will, but as a former banker yourself, when you look across the continent, is there one European city which you see that offers the same sort of infrastructure, legal framework, even the capacity to match what London can offer?
No, London, and I expect London to maintain the financial center of the region for a long time. We are working under a single rule book, so it should be very much making no difference whether or not the banks will partially relocate either to Dublin, Amsterdam, Paris or Frankfurt. When you say we're not promoting Frankfurt as a financial center, we're also not working against Frankfurt as a financial center, but we don't see it as the job of the central bank to promote one single center over another, but to make sure that we don't have a race to the bottom in regulation and supervision, and that we all work from the same platform. Now, if should the banks which partially relocate from London or relocate, let's say, to Paris, I am willing to offer my good colleague in Paris some of my staff in order to make sure that we don't go into a cliff edge effect or in any other city, because what we really have to make sure is that this is not going to become a dangerous situation, but a situation which we manage on a European basis as two Europeans.
And would it be a problem, say, moving the European Banking Authority from Canary Wharf in London to somewhere else in Europe? I mean, if the option does come up.
Yeah, I think it will have to be moved because, we are expecting a Brexit, and then the European Banking Authority cannot really stay in Canary Wharf for much longer. But where it will move, that is going to be a political decision, and central banks for sure don't have a say in that.
All right, Andreas, I want to ask you about the health of the German economy here. We had the Chancellor, Angela Merkel, speaking to a group of students today saying, that trade surplus is a concern, but only if you can increase domestic spending. She's blaming the euro that's been too weak as of late. What do you think needs to happen? Is it about domestic consumption? Is it as simplistic as that?
No, the German economy is doing rather well. We have seen a GDP growth of 0.6% in the first quarter. on a quarterly basis, of course, not on an annual basis. If you compare that with the fourth quarter of last year of 2016, that was at 0.4. So we're doing better. We expect very good labor markets in Germany, which means that unemployment is going to be low, and that there will be some wage increases possible, which would mean that, of course, also consumption could go up. So we foresee a robust economy in Germany, not only for the next quarters, but also for 2017 and 2018 and 2019. So quite a sustainable, a good economic path in Germany, in the heartland of Europe.
Okay, that's Europe, but if you take a look at the global picture, there are some concerns. I want to dive into my Bloomberg right now. ECTR Go for our Bloomberg subscribers out there, and you can see the trade relationships. Look at the really dependent relationships that Germany has with China and the U.S. You got political turmoil in the U.S. It's spilling over into global markets right now, Andreas. And we're also seeing some key Chinese economic indicators coming in a little below estimates. How do you make sure that that doesn't drag down the health of the overall German economy?
Now, when I listen to you, you almost can get the feeling that we're ahead of an immediate collapse in the Chinese economy. That is not the case whatsoever. We don't see that. We see also, at least for the short to medium future, a solid economic development in China. So that's all I can say. With regard to trade and political circumstances, we have to wait and see how things develop. But the economic foundation for what we are talking is reasonably strong, especially in China, and we don't see anything like an immediate collapse in the Chinese economy or in the